What if I told you that a few comments from the Federal Reserve were enough to wipe hundreds of billions of dollars off the stock market in a matter of hours? Not a war, not a recession, just words from the Fed. Today, markets are nervous, investors are divided, and confidence in the most powerful financial institution in the world is being questioned. And if you have money in stocks, crypto, real estate, or even a savings account, this affects you. So what exactly happened, and why did the market react so violently? In this video, we're breaking down what the current Fed controversy is really about, why markets hate uncertainty more than bad news, how stocks, bonds, crypto, and gold reacted, and what this could mean for your money going forward. Make sure you stay till the end, because one of these facts completely caught Wall Street off guard. Now let's get into it. What is the Fed and why it matters? First, let's level set. The Federal Reserve controls interest rates, money supply, and ultimately the cost of borrowing in the US economy. When the Fed raises rates, borrowing gets more expensive. When it cuts rates, money flows easier. That means mortgage rates, credit card interest, car loans, business expansion, stock valuations, all of it is tied to the Fed. That's why investors don't just listen to what the Fed does, they obsess over what the Fed says. The controversy. Why markets got spooked. Here's where the controversy comes in. Recently, markets expected clear signals that interest rate cuts were coming. Inflation has cooled compared to previous years, and investors were pricing in easier monetary policy. But instead, the Fed delivered mixed messaging. Some officials suggested rates may stay higher for longer, others warned inflation could resurface, and political pressure around rate decisions started creeping into the conversation. That created a massive problem: uncertainty. Markets don't panic because something is bad, they panic when they don't know what's next. How the market reacted. And the reaction was immediate. Stocks sold off, especially banks, growth stocks, tech companies dependent on cheap money. Why? Because higher rates mean lower future profits, higher borrowing costs, lower company valuations. Bond yields jumped, signaling investors demanding higher returns for holding government debt. Crypto saw volatility as risk appetite dropped, and money rushed into traditional safe havens like gold and cash. This wasn't random, it was a textbook reaction to policy uncertainty. Why Fed independence matters so much. One of the biggest underlying fears here is Fed independence. Historically, the Fed is supposed to operate independently from politics. Why? Because if interest rates are controlled for political reasons, inflation can spiral out of control. When investors even sense that politics might influence rate decisions, confidence cracks. And once confidence cracks, markets move fast. What this means for investors right now. So what does this actually mean for you? First, volatility is likely to stay high. Second, markets will overreact to every Fed comment. Third, long-term investors need to separate noise from fundamentals. Periods like this reward discipline, risk management, and understanding macro trends. Short-term traders may panic. Long-term investors look for opportunity. What to watch next? Going forward, here's what really matters: inflation data, employment numbers, and most importantly, clarity from the Fed. The moment markets feel confident again, sentiment can flip fast. Which one of the facts we talked about today was the most surprising or interesting to you? Was it the market sell-off, the role of Fed independence, or how sensitive stocks are to interest rates? Write it down in the comments section. If you liked this video, don't forget to like, comment, and share it with your friends. And if you're new to the channel, don't forget to subscribe and turn on your post notifications so you never miss another breakdown like this. I'll see you in the next one.